let's start. Hi, everyone. Welcome to the Data Scientist Podcast. I'm here today with Nik Pletikos, who is a tokenomist and a head of Treasury at Sweatcoin. Hi, Nik. How are you?
Hi, everyone. Thanks for having me. Yeah, all being good at the moment, so all well. Maybe if you start by introducing myself very briefly.
Yeah, please do so.
You already started. Yeah, my name is Nik, and I'm currently head of Treasury at Sweat Economy. I've been, let's say, involved in tokenomics Treasury for quite some time. For the last 3 or 4 years, more actively in the crypto space. I've been, let's say, full-time in crypto since early 2019 when I joined BOOTCAMPS, the oldest current running crypto exchange, where I helped build, let's say, the treasury department from the ground up. Apart from this, I've been quite actively involved in the, let's say, crypto startup scene, building, advising, but mostly sticking to the token economics and treasury roles, let's say.
Perfect. So it looks like you're an old-timer in the space of treasury management. I think, correct me if I'm wrong, that treasury management became more popular after the collapse of Terra Luna. What's your opinion on that? Do you see that more and more companies are looking into this type of service? That's one. And secondly, the second thing I wanted to ask you is, do you really think that Terra Luna could have been saved if the team had managed the treasury in a better way? What's your opinion?
Well, it definitely gets more traction, particularly after the FTX crash, let's say. Maybe in traditional finance, there's quite a lot of metrics and treasury management principles that are in place. They're slowly migrating to the crypto as well. Let's say a year ago, there was practically non-existing, or let's say a very minor percentage. But yeah, particularly since the FTX crash, it increased quite a lot. Maybe Luna Terra situation couldn't be, let's say, handled to an extent from the project perspective and the treasury project perspective, because it was in essence mostly connected to the smart contracts and how they structured the tokenomics behind, right? How the value flow from one token to another. But the projects that were overexposed to Luna, definitely, with the right to treasury management approach, with the right risk management, they could minimize the risk that they were having particularly towards UST, which was paying, I think, 20% at the time, and everybody thought that it's like a normal stable coin and it can be pegged, and they were overexposed to it, right? And similar for the FTX, it seems like one of the most trusted exchanges at the time, so everybody was pretty much overexposed to them, and then they were locked out of the funds once it crashed. And on the other hand, also from the FTX point of view, they essentially dug a hole into their balance sheets, right? And they didn't have enough liquid assets to cover all the withdrawals, and once the withdrawals started to happen, they weren't able to meet the demand, and this is why it crashed, essentially. So yeah, particularly the FTX story, let's say, is a consequence of a poor treasury management.
I see. And are there like any general principles or guidelines for managing a treasury?
Well, there are a few. There are quite a lot of books, let's say, that tackle the traditional finance and how to manage the treasury and what the principle should be. But I say in crypto, it's a bit more simple to an extent, though let's say the mechanics behind this, or the frequency behind is much higher, let's say. So you have to act much faster than in traditional finance, but you don't have so many sophisticated tools at this point if we, let's say, don't account for all the DeFi derivatives that are pretty risky at this point. But definitely one of the key principles of treasury management is how to handle the risk, right? The risk management part of the treasury. So this is particularly important in crypto for the early stage startups, as well as some of the bigger firms on how to safeguard the assets primarily, and then you try to find and seek some additional return on the assets that you hold, right? But if you're overexposed to certain investment, overexposed to a certain bank or exchange, and if it goes bust, then you have big problems, right? Particularly with the liquidity, with the runway. So this is what happened with a lot of projects, both in the Terra Luna crash and in the FTX. So it was to an extent, let's say, linked to the risk management, but also the managing of the liquid funds, right? Where they placed it, how they managed it, and how essentially they safeguarded it.
Mm-hmm. And so what are like some principles in terms, for example, of assets to invest in? Is it more like stable coins? Is Bitcoin now considered a safe asset? Yeah, do you, like, if you have a treasury, is it okay if you also invest in some speculative assets, or that's not the purpose? Are you more like focused on preserving value, or also growing the value and trying to beat inflation? So what's the general principle?
I think that in crypto in general, it's about the safeguarding of the assets, because the crypto as an industry is, let's say, pretty volatile, pretty risky in its core, right? You have smart contracts that are risky. You have the general market that is pretty risky or volatile, if you say so. So it's the primary thing should be to safeguard the assets and to protect the runway, particularly if you're not generating any revenue at this point. And then, of course, if your treasury grows, or once your treasury is big enough to be able to invest some of it, then definitely you go from, let's say, safer investment. This could be also in traditional finance. Now the USD bills are very popular because they offer you a relatively high yield compared to some of the DeFi on-chain strategies. And you have also some on-chain, let's say, on-chain products that give you exposure to the US government bonds as well. This is one part, and then the second part is definitely, let's say, more bit long-term investments such as Bitcoin, Ethereum, and some of the, let's say, blue chips of crypto. And of course, some small percentage of the treasury, if let's say the allocation allows you, it could be invested in a more risky manner, right? But it all comes to the risk management and protecting your capital as the main priority.
I see. And how can you stress test treasury management? I know that you're a big fan of simulations, so I was looking forward to hearing more about that.
Yeah, it's still let's say also the risk management and the stress testing is still pretty new in crypto. I haven't seen like a lot of people doing it, right? But it's pretty much from the current state, and the treasury frameworks are still relatively simple because most of the projects are, let's say, relatively small in a treasury valuation if you compare to the traditional finance. The most common approach is to let's say to perform a series of stress tests, particularly on the yield, let's say yield raising or yield drops, so the interest rate risk, right? And then also if you're investing in a non-stable asset, you can perform some stress tests on how the prices would act in a different market environment. So for example, if you hold, I don't know, 50% of your treasury in Bitcoin, you can stress test it for different market states. So for example, if you have a prolonged bear market and you expect Bitcoin to decrease for another, I don't know, 70-80%, you stress test this and you see how your runway shrinks if you would keep the same, let's say, same Bitcoin exposure, and vice versa. If the market goes in a bull, you apply some percentage, or you check the historical data and you stress test it how the amount would increase. And you have also like a black swan event, so the worst case scenario, so you could really stress test your treasuries for all the risks that you have to really see, okay, in the worst case scenario, we are left with this much and this much of a runway, because as I said, the first and foremost is to protect your runway, right? And then yeah, the simulations can be from pretty simple ones. You apply like a linear percentage, or you divide it by quarters, or you can perform some Monte Carlo simulations. You can do value at risk simulations for the volatility of the assets or the portfolio as such. So it really depends. But yeah, as I said, it's still relatively low adoption of this within the crypto, maybe because the most of the treasuries, if we don't account for the largest projects, are still let's say in a few millions. So it's probably not relevant for them, or probably not viable for them to perform all sorts of stress tests, because yeah, the effect is relatively low. And if you safeguard your assets, right, which should be your priority if you are, let's say, a smaller project, then you don't really, let's say, have the particularly need to really stress test all the holdings that you have, particularly if you are, let's say, exposed in the fiat and stablecoins for the most part, right? Once you start to shift to the DeFi protocols, to the other non-stable assets, then definitely stress testing becomes more important, because also your treasury becomes more volatile.
And are there any projects that you think they're doing it right? You're like, yeah, these guys, they really understand what treasury management is about, and other projects should imitate them. Like are there any of the big protocols, doing something right, which others should imitate?
Well, I particularly like what MakerDAO did with their treasury. They hold like a huge treasury, right? And they invested in the T-bills, I think like 500 million in the past, and they recently increased their balance to 1.25 billion or something. So it's quite a huge, let's say, allocation. But as the T-bills are currently paying between 4 and 5%. With such a huge allocation, you can, the DAO Maker project can earn like 500 million per year, right? Which is quite a substantial amount. And they opted in for the, let's say, ladder strategy. So they essentially have a portion of their T-bills matured every 2 weeks or so. Which is actually really good, because you have ongoing liquidity unlocked, right? So if in case you need some more liquidity in a 2 weeks time, you know that it will get unlocked a certain percentage of your funds. And if you need more in two weeks time, there are another percentage unlocked, right? So it's not that you're locked for a longer period, but you still collect the interest, right? And if you see, okay, we don't need the liquidity, just reinvest the T-bills for the same maturity. So in the current, let's say, market state, I think this is the main, or the best option you could do. What could be, let's say, tricky here for smaller projects is the entry barrier, right? Because particularly in traditional finance, most of the T-bill providers ask for, let's say, minimum size deposit, right? So usually it could be around 10 million, even higher, depending on who interact with. You have some solutions that are a bit more risky, a bit different counterparty risk, that can offer a lower exposure. But if you want to go directly to the bank or asset management provider, it's usually around the 10 million, right? Which is quite a high entry barrier for a smaller startup project.
I see. And before we go, I wanted to also ask you about tokenomics, like whether you see any interesting developments in that area, like because tokenomics has evolved a lot since since when it started with the let's say the creation of Ethereum. And I don't know whether there are like any particular trends that you find exciting or interesting, or you'd like to comment on. So we've seen in the last few years the rise of DeFi, NFTs, the metaverse. I keep seeing like commentary about, let's say, new tokenomics models and tactics. Is there anything which stands out? Anything which you particularly like? Yeah.
Yeah, maybe for the last few months, the project got the most traction is the GMX derivatives exchange, right? The decentralized derivatives exchange. They, let's say, not reinvented, but they put the tokenomics a bit different. They have a dual token system, and they eventually reward the users for being active on the platform, for trading more, bringing more volume, right? And they reward them with their own tokens. They have a certain mechanism in place, not to, let's say, inflate the token, and not to, not to have any huge sell pressure. And it worked pretty well in the last year. I think they outperformed the market. I think they outperformed the Bitcoin for quite a large margin. And there are quite a lot of copycats in the last few months that are going with a similar approach, but a bit different tokenomics. I think the Level Finance has a really good foundation of how they build their tokenomics, but it goes, let's say, more and more into details, more and more into maybe game theory and math, right? So it becomes more complex, and it's also, I'd say that it's hard to, it works in theory once you launch it, right? But it probably can't really test it 100% until it gets some traction and you see how people behave and how they interact with the tokens within the ecosystem, rather than you see if you need to, let's say, change some parameters, etc. But in general, I think here is the major shift in thinking in token economics, not just rewarding the users with, I don't know, staking rewards or airdrops, because most of these rewards end up in a sell pressure, right? Users usually cash out, and that's it. But try to lock them in for certain mechanisms, or incentivize them to restake, to reuse those tokens for a longer period of time, which essentially, as was the case with GMX, resulted in more volume on the platform, as well as appreciation of their tokens, right? But again, it's not it's something that usually, or at least in Score, works with the DeFi, particularly with the decentralized exchanges and similar types of protocols, right? You can really apply it to, I don't know, DApps or metaverse or GameFi projects. I mean, you can use some of the parameters or let's say some of the features that you think could help you grow, but it's a bit, let's say, linked to the fees that you're collecting within the DEX that are really making it interesting for the users to keep, using it and keep staking the token.
Yeah, I think you definitely hit the nail on the head. So the whole problem with rewards in many protocols is, how do you make sure that the reward actually gets reused somehow? And for me, something else that's very important is that the protocol should generate some real world value. So the rewards is not just fake internet money,
Yeah, exactly. Because it usually incentivizes the early users. They come in, collect the funds, collect the yield, and then once the initial hype goes down, your token price starts to decline, and it's practically it's over for the project. Once you start go in the death spiral, it's over, right? Once you start paying so you have to have additional utility. It's not just that you have a token for nice to have and for paying out the reward.
Yeah, exactly. Awesome, great stuff. So I think we're reaching the end of this episode. Where can our listeners learn more about you? LinkedIn, personal website?
Yeah, LinkedIn. I'm more active on LinkedIn, so definitely, please, if you have any questions, if you want to chat, feel free to reach out to me on LinkedIn. I recently started to write a newsletter on the Treasury tokenomics topics. It's treasurer.substack.com, so feel free to check the articles that I wrote there. And yeah, I'm also on Twitter, but LinkedIn would be, let's say, my primary social channel to be active.
Perfect. Thank you, Nik. It's been a pleasure.
Thank you. Thank you very much.
Yeah, thanks everyone. Thank you for staying here with us, and make sure to check out the datascientist.com for more content around AI, blockchain, and Web3. Thank you.